Let's move on now to market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Murio, and today we're looking at Friday's jobs number and its potential effect on risk assets on the dollar. We're also looking at a week where we have huge tech earnings in Facebook, Alibaba, Google, Amazon, Apple, all between now and the end of the week. And that's one of the reasons we talk about these weekly options. On a previous show, we talked about using the NQ weekly options that go off this Friday. But we're going to look at how the jobs number affects risk assets, the dollar, and today we're looking at the oldest of the risk-off assets, and that's gold, and ways to create exposure and mitigate risk. Joining me is Chief Investment Officer, Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, what is going to react the most to the jobs number? The dollar, stocks, gold, and please explain your answer.
All three? Yeah, okay. I mean, how much time do we have in that? But here's what I do think. Given the recent trends, I believe it's going to be the dollar. The dollar's had a lot of rumors circulating around. We've had a lot of executives talking about it, at least as far as the government goes, a lot of government officials, rather. And so, therefore, I believe the dollar almost feels like it's somewhat under attack here. Therefore, it's likeliest to react.
Why have stocks and gold moved together during this little stock sell-off?
That's a strange thing. I don't have a perfect answer for you, Jim, other than the fact it felt like there was a lot of liquidation going out there. So what happens is you see that spread along many asset classes when there is such a selling
my
period.
belief is that the sell-off in stocks has been somewhat measured. There's been no great gaps and no panic selling. So right now, gold feels okay. Do you like that explanation?
I do like that explanation from the standpoint as long as gold gets back to its roots, which is risk mitigation. Because like you mentioned, in that sell-off, you weren't exactly happy if you were holding gold as a hedge, let's say, on equity.
I like that. Yeah. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we price these out, the April gold contract's trading $13.40. Scott.
So we talked about the goofiness in the GC trade in the last few days, or at least on the recent market sell-off. And what I'm chalking that up to so far, Jim, is an anomaly. Okay, I'm going to say that was maybe just a oops on the side of GC, let's say. And looking at GC to come back into, say, that risk mitigation phase. So specifically, Jim, punch up something I think kind of interesting here, and it almost makes me nervous to talk about because it feels like it's almost too good to be true. That is specifically, wait for it, the 1350, 1360 call spread, the week 3 Februaries. Okay, so that's going to cost you 2.8 ticks to put on, or risking the 280 that it costs to make a potential 720 if it completely fills up. As I mentioned, it expires week 3, so you have some time. But I'm thinking just with respect to how gold is behaving, it should get back somewhat of that, say, hedge against equity, and therefore equities that are getting more volatile should like gold here.
I'm going to give mine, but I actually almost like yours better because that risk reward is good because yours is only 10 ticks above where the market is right now. Yeah. Now remember in gold that calls trade with a premium because disaster exists to the upside. So usually calls are expensive. That's one of the reasons we do call spreads. And I'm looking at buying the week 3 Feb, the same expiration years, the 1365, 1375 call spread for 1.5 ticks. This trade risks 150 to make a potential 850. So it's just two different ways to look at it. Yours is more likely to happen, and the market can tell you exactly how much more likely, almost twice as much more likely to happen is what the market says. That's why yours is twice as much money, and mine pays off more if it goes higher.
Correct. And I like them both. I like the risk-reward expression there, but it's just one of those weird trades, Jim. We talk about this a lot where sometimes it's tough to go into a trade being like, I want to be long, I want to be short, I want to express myself one way no matter what, right? Because you punch up something and you're like, wait a second, the risk-reward is so attractive. This is one of those scenarios where, gosh, it almost feels too good to be true, like I said, because it's so cheap.
I like it. Now, if you look at the long-term chart of gold, it looks like 1365, 1360 is breaking out of it. We peaked above it a little bit ago, but then we failed. If we go it again, that's why I think it's going to accelerate. And also, that's going to coincide with 88 in the dollar index. If we go below that in the dollar index, gold could move.
And I'd add to that a spike in the VIX, my friend, which we've seen already the last few days. So, hey, that's certainly in the cards possibility.
Thanks for joining us in the special edition of Market Movers. I'm Jim Murio, where we're hoping to make you a better trader.
You